up? We are back with another stock analysis. Today we'll be looking at AppLovin Corp. So they are a mobile marketing platform. They've been trending recently. Fairly large company, actually, well over 100 billion market cap. So we are going to get into them, see what they've been up to, and go over the full financials analysis. Probably going to be doing a valuation here too, because they actually do have positive earnings per share. So yeah, let's get into it and make sure to subscribe. So starting off here, like I said, mobile marketing, they have a couple different segments here that they offer, or products that they offer. I don't really know what any of them are, to be completely honest. I feel like I reviewed this company in the past, but it was probably months ago at this point, and I've done so many of these that I honestly don't remember. But anyway, $128 billion market cap. Target price at 541 and long-term growth rate of 33%, which is pretty high. Currently, we're at 331. So there is a ton of upside that is expected here, according to FactSet at least, which is very interesting. If you look at the mini chart here, you can see they have been on an uptrend since the beginning of 2023 and really have not slowed down at all. Almost only going up since then, which is pretty interesting to see, especially considering how high their target price still is. One other thing, growth summary isn't too long-term, but we do have very positive short-term estimates, which is always good to see. So that is, of course, something to consider. Moving on to the financials, we will look at their quarterly growth, because this company has been growing so much recently that the best way to see it is quarter over quarter. So in the past 2 years, they have basically doubled their sales. Cost of goods sold have essentially stayed the same that entire time, by the way, which is nearly unheard of. SG&A expense has gone up, though, in roughly the same, not really that much, though. Cost of goods sold have gone, or SG&A expense has gone up around 30%, while sales have nearly doubled. So over the past 2 years, by the way, that is not crazy at all. That's actually really good. Operating income looks solid, consistently increasing with sales, and net income, same exact thing, very solid as well. EPS are also positive, so we will be doing a valuation today. And moving on now to the balance sheet, let's see what we have going on here. So total assets are nearly at an all-time high. It looks like they actually decreased in 2023. Let's zoom out to the years and see what's been going on with their assets. So it looks like they have been steady with their assets, roughly declining slightly since 2021, but overall that does not matter at all because of one thing, and that is sales growth. So as long as their sales are growing, assets do not matter at all. They have 700 million in cash, very little short-term debt, but they do have $3.5 billion in long-term debt, which isn't great, but I would say it's not the end of the world, just considering they are making a decent amount of money. And actually, going back to the income statement, let me just see the numbers here. So 1.3 billion in sales. The one thing I will say to that, which I'm just thinking about right now, is that this is if we go to the right section here, this is a over $100 billion company, which is kind of insane when you think about it. I'm sure their PE ratio is very high, and it's putting it at 71 for 2024, which is very high. That's kind of crazy. I would say that considering their sales are probably right around 1% of their market cap, this company is likely overvalued, at least for the short term, until their sales can catch up to their valuation. Again, this is like a mobile marketing company, very high growth field. So there is a sense of that in the valuation as well. But overall, I would say that there is definitely some concerns for how high that valuation is. So we'll have to see where it goes with that. But overall, I think the long-term debt situation is perfectly fine. It is steadily increasing, but I mean, they have an okay amount of cash. And on top of that, their sales are increasingly positive every single quarter. So I think it is perfectly fine. Looking into their cash flows now, let's see how we're doing here. So operating cash flows have exploded in the past 2 years, which is great. Investing activity, we don't really see too much action. They did have some acquisition activity going on 2 years ago, or in the past 2 years, not including 2024. Other than that, some debt reduction over the past 3 quarters. However, there was a lot more issuance at the beginning of the year. And other than that, I'm not seeing anything else too crazy. Free cash flow is very positive and actually the most positive we have ever seen. So looks good there. Let's go to the ratio analysis and see what is happening here. So overall, I think all ratios should be improving, and we do not have the fiscal quarters, unfortunately. But we do have gross margin massively above 5-year average. Same thing with operating, same thing with net. Return on equity at 134% is insane, but overall still very, very good. And their debt to equity is actually very, very high. So I did say I don't think the debt is much of a concern. Based on this ratio, I would say that they are definitely at an unhealthy level. However, just going back into their snapshot here, their market cap being at $128 billion tells me that that 3 billion in debt really isn't anything crazy to think about. Now, I don't know if they are just at the most insane valuation I have ever seen or what, but considering they went from $9-10 to over 300 in about 2 years is kind of leading me in the direction of, yeah, FactSet's numbers are a little bit off at the moment. I'm not sure why. This shows their current price at $17 a share. So why does I'm looking at Zeta. Oops, APP. Um, Anyway, completely ignore that. But FactSet's numbers are just kind of insane here. So this company exploded so rapidly over the course of 2024 that their valuation and their earnings just don't seem to have been able to catch up with each other. We're seeing a ton of volume coming from them recently as well, where their stock price is very clearly moving much more than it used to in the past. That started towards the end of 2024, but still the numbers here are crazy. They are up a lot post market though today, after being down 12% on the day today, which is kind of crazy. But overall, here is the weekly chart. You can see a little bit better and gaining, let's see, 77% in one day a couple months ago and 35% in one day just about 2 weeks ago. That is insane. The growth that this company is seeing is just crazy. That's all I can really say right now is the growth is insane. Ratios look great. Other than their debt situation is a little bit rough. And now let's get into what their last earnings was looking like. So starting off with the recap, and then we do have a street takeaways as well. Let's get into these. So revenue massively beat on software. Apps also came in slightly above. EBITDA margin beat. Monthly active payers came in 200,000 lower. However, average revenue per payer came in 10% higher. So I I don't really know how to determine that too well because 10% of 1.8 would be 180,000 and they dropped by 200,000 but they increased by 10%. So overall I would expect them to be losing out there, but it seems like just based on where their revenue is, they still beat. So either way, they're doing better in terms of revenue and margins, but just seeing that monthly active payers going down so much seems a little concerning to me. Let's look at the street takeaways though. So revenue was ahead, primarily driven by software platform. EBITDA was up. Monthly active payers, like I said, down year over year, and then the revenue was up. So management guided Q1 2025 10% higher and revenue slightly above. Additionally, they announced the sale of their mobile gaming business. So that is definitely something very, I don't want to say concerning, but that's definitely why the stock dropped so much, like we saw after that earnings report. By selling that off, that's essentially a huge part of their business that is just gone. Um, which isn't great, but overall, if they're still performing the way they're performing, I would say that's perfectly fine. Um, Even still, just based on where their valuation is, selling off a segment of their business, I can't believe their valuation is as high as it is. Analysts are still largely upbeat following strong advertising performance, model improvements, and growth expansion into new things like fintech, insurance, automotive, and healthcare, seen as a significant growth driver. So, if they can expand into all of those sectors, especially things like fintech, insurance too, very high growth fields. That's great. Question remains about scaling, which again, if they can get into those high growth fields, that would be excellent. Quarter one guidance was viewed as conservative. However, they also increased it, but potentially underestimating non gaming contribution, while divestment of gaming business seen as simplifying the narrative. So, analysts did raise price targets and expectations of continued growth. However, some acknowledge the multiple is less attractive at current levels. So, that's also what I'm thinking. However, just the way the valuations of this company is currently seems insane. Price targets at $600 from 437. That would be a 250-ish billion-dollar market cap. That it just does not seem right based on them. If we go back to the revenue income statement, they're I'm looking at the yeah, that would probably make sense too. Even still, $4.7 billion in sales based on $250 billion market cap, possibly. That's crazy. No matter what. So, saying that, I think that is all I have for that section. Let's see about an valuation based on their competitors. So, hopefully, we have something decent in here. PEs are actually, wow, they are coming in mostly in line with competitors, very slightly undervalued. However, if we look at the fiscal year two, which is what FY2 here means, that is the next fiscal year that they'll be reporting, they're actually going to come in undervalued versus competitors. So, very interesting there. Let's see about what the PE shows up here. So if I put in the PE into Google Finance here and go through the calculations, it gives a PE of 100 right now. Which is kind of crazy, but still that valuation is pretty high. So I think we're going to go off of the PEs that are showing here and seeing fiscal year one, that will be slightly overvalued, 52.45 and 56.31. So let's put that in here and 56.31. And that gives an average for the sector of 54. And if we just look at theirs, it will be 57.03. So putting that in for that, it gives a crap. What do I have to do here to, I just have to do that divided by that equals what the EPS is expected to be, which gives a very slight downside of 4.8%. So not bad there. Even just showing in line with its price compared to its competitors is shocking to me. Software sector as a whole just seems like it is higher average PEs than we normally see, which is perfectly fine. But overall, I would say that's kind of crazy. So looking at fiscal year two, let's go over the price there. So 38.27 is showing up for that. And then we have 43.71 and 39.18. And 39.18. And that gives an upside of around 8%. So that is a little bit better, which is fine. So pretty solid across the board for the valuations. I would say everything here looks pretty good. Based on how much they've fallen recently, you could possibly say it's a good time to buy. But just with how aggressive the growth is and how high their market cap is, I would be a little cautious. I think there is some benefit to this, but overall, I just stay a little wary of companies that are up this high with revenues that don't back it up a crazy amount. So that's all I got for today. Thanks for watching and make sure to subscribe if you haven't, and I will see everybody in the next video.